Celia, thank you so much for joining us this afternoon, and we're grateful for your time. Thank you.
Thank you very much, Eugene. Good afternoon, everyone. Thank you very much for your time today to come out and listen to our stories. I'll try to keep it brief. I think it's just myself and another speaker who are standing between yourselves and lunch. My topic for today is diversification for resilience and positioning for opportunities. The reason why this is so topical is that earlier on in the morning, you heard from the equity managers talking the story about equities, then you heard from the fixed income managers as well. At any given point in time, those strategies have a place in client portfolios. What we do as a multi-asset manager in this particular product is that we do that work for you. We'll look at the dynamic overall in the market and say this is the right time to be overweight equities, or this is the right time to be overweight fixed income. Who are we? We were founded in 2003 by a gentleman by the name of Patrice Moyal, and we are founded as a hedge fund manager. And over the years, we've developed various products, including long equities. We continue with our hedge funds. We've got Pan-Africa exposure. And in addition to that, we've got the multi-asset that I just spoke to. So I joined in September 2010. It's actually just, call it just under 15 years now. I think I joined on the 28th of September 2010. And it was to run the Pan-Africa funds. And those have done reasonably well. I think you've heard from the previous speaker talking about the opportunities that they see in the rest of the continent. We hold the same view, and we've got our ears to the ground in that segment. What's the market outlook? The previous speakers, particularly on the equity side, they spoke about the opportunities that they see in South Africa versus the rest of the world. We are no different. Equities are basically a geared play on what the economy does. If the economy is doing poorly, equities in aggregate will do poorly. This chart here shows expected GDP growth numbers for the world, segmented by different countries, and then by geographies, your EM and your G7 economies. What you can clearly see from all of them here is that they're all expected to actually show lower growth over 2026 to 2030 compared to the previous 10 years. If you look at China, previous 10 years, it was 6.8% growth. Then looking forward, 26 to 30, 3.9%. The same with India, lower growth going forward. US, lower growth going forward. The exception here is South Africa. We've been a low-growth economy, but our expectation is that, as per the World Bank, is that growth is actually going to accelerate from what we've seen. I think the latest numbers, we're expecting about 1% growth for this year and jumping to 1.6% in the periods that follow. So this is an exception to the rest of the world. Then this slide covers the same thing. We're looking for a revision in growth upwards versus the rest of the world. Inflation, it's a similar picture. However, it's mainly the emerging markets where you've got inflation coming down. China, India, you've got South Africa there, and the region as a whole of emerging markets, inflation is coming down. Rest of the world, developed world, you've got inflation going up. I think the fixed income speakers before me, they spoke about how the US inflation is remaining sticky at the plus 3% level. That's a similar level to what we're experiencing here in South Africa, which is quite an anomaly. So when it comes to equities, I've said our growth is expected to accelerate from where we are. but that's not discounted in our valuations at present. Right? We're still trading below the averages that we've seen over the past 10 years, and our view is that there is limited downside at the present level from getting involved in the equity space. The US, on the other hand, speaker before me, it's looking a little bit frothy. There may be some reasons, but in aggregate, it's looking frothy. It's trading well above its 10-year average. So for SA equities, this compared to the fixed income space, we believe equities are cheap enough in absolute terms versus their own history, and they are now cheap enough versus fixed income space. So as a result, we think it's a great opportunity to start getting involved in that space, and that's what we're expressing in our fund. So we're basically doing it for our investors. We're not saying, because this can change very quickly as well, where the dynamic changes, and we will say you might have to start getting involved in fixed income again, should that picture change materially. What investment opportunities are we seeing? I mean, I spoke about this earlier on. So we'll give you exposure to domestic equities, we'll give you exposure to domestic bonds, and property and cash as well. Versus the benchmark, that allocation that you saw in the previous slide has far outperformed the CPI plus 5, which is the target benchmark for the fund. What are we doing? Currently, we are underweight equities, but we are constructive equities. So we are upweighting because we believe that valuations are attractive, but the environment is quite volatile. We are using this volatility to actually pick up interesting names at attractive prices. On the property side, we like property. The market has turned there. Their balance sheets have been repaired. These are the property companies. The balance sheets have been repaired, and now for a change, it's starting to see great growth in yield. Call it mid-single digits. So we think that income underpin is quite positive for the sector. So we're running an overweight position there, and we have not changed it. On the fixed income side, we're pretty much in line with our strategic asset allocation, but we've increased our exposures to inflation-linked bonds, and we've shortened duration. And you'll see in the next slide the reasons for why we've increased exposure to ILBs. We still overweight cash at the present moment, but we are deploying it selectively as opportunities come through as a result of pullbacks that we may see in the market. I think I'll skip quickly through the slide, but this basically just shows where we are positioned versus the strategic asset allocation. I mentioned we are underweight equities, 62.5% versus 65% in the strategic. We are overweight cash, 5.3%, and domestic bonds, we are neutral with property overweight. I spoke earlier on about our expectations. We've got 15% in equities. However, our process says because risk is elevated or volatility is elevated at current, the prudent thing may be to be underweight. And when prices drop, we will pick up more of the equities, and as the environment normalizes a bit, then you might find us in overweight equities. So I mentioned overweight domestic property and slightly neutral on domestic bonds. I mentioned earlier on that we're buying some ILBs and the short end, and the reason for that, I think the fixed income speakers spoke to this earlier on. We believe our research tells us that historically, when inflation has bottomed, which we believe we have, looking forward for the next 12 months, ILBs have actually outperformed nominals. So we are tilting our portfolio to ILBs versus nominals, though we are remaining neutral on fixed income. On the equity space, I think I'll stress mainly what we're looking for. When we put a company into our funds, it has to meet the inclusion criteria, which stay in the middle. It has to have strong corporate governance, experienced management team, strong cash flows, and also solid balance sheets. We don't know for certain that the economic environment is going to turn next year, but should it not turn, these are the companies that are best placed to continue navigating the tough environment. I think I'll call out Momentum here. We got involved in Momentum in 2022. It was cheap, it was underperforming peers, and we could identify that there's some efficiencies that the new management team at that time could actually drive out of the business and put it on a better footing. Over that period, since we got involved, we've returned about 150%. More recently, we've gotten involved with All Mutual. It's been in the funds for now the past month and a half or so. And we believe that it is a similar picture, right? They've underperformed their peers, Sanlam, Momentum, Discovery. They've got a new management team as well at the present. And we are aligned that there are inefficiencies within the business which they can unlock and which will drive shareholder value creation. They announced their results last week, and they announced with the result a 3 billion rand share buyback because the stock is cheap, it's trading at about 7 times PE, and it's giving you an 8% dividend yield. So how we engage with these companies, because the environment has been tough, okay, we'll write letters to the management teams. Okay, this is what we're saying, this is what we believe the improvements you can make within your businesses, which should further drive shareholder value. So we started with Momentum 2022. These are the most recent ones with All Mutual, and we hope that we can replicate the success that we've had with Momentum. How has the fund done versus our peers? Over the past 3 years, so we've generated returns ahead of our peers, just in excess of 2 percentage points, with a 15.8% return versus peers at 13.1. On the equity side, we've seen an improvement. We're now collecting the second quartile, with the rest of the other funds in the first quartile. And having said that, in aggregate, our funds are ahead of our peers over the past few years. So these are just some of the awards that we've received over the past 2 years. And that's it from me. Thank you very much.